Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Credit and debt are the two sides of the same coin. Credit worthiness is required to secure debt. Therefore, debt can't grow unless the credit worthiness growth rate is matching it or has preceded it. This is why I always say in my newsletters that credit leads, markets follow. We are going to explore both sides of this coin in this session with a keen eye on the signals coming out of the U.S. fiscal and monetary policy that affect both credit and the assumption of the important elements of debt. As such, I'll cover the subjects outlined here. We'll begin with the big disruptor to credit and debt, inflation, and the destabilizing shock it can have on a complex, risk-averse, and highly sensitive global financial system. The bigger inflation is, the higher prices rise, the bigger credit and debt levels required. The bigger the debt in our financial system, the bigger the GDP. Interestingly, everyone loves a bigger GDP, but only a select few love inflation. That is important to understand and which camp players are in. You may not be in the same camp as your own government. The U.S. public has experienced goods and services increase by an official rate of 5% from 2000 to 2016. From 2016 to 2020, things became 8% more expensive. From 2020 to today, things have become 21% more expensive. What this has meant is a cumulative 34% increase in prices. To most people, everything is one-third more expensive to even exist today than a decade ago. Many pensioners living on CPI-based COLA adjustments would likely, and I suggest angrily, suggest the official numbers are bogus. U.S. workers see that their real disposable income simply hasn't kept up and feel they are falling behind. U.S. real disposable income fell over $1 trillion in 2022, the second largest percentage drop in real disposable income ever, behind only 1932, the worst year of the Great Depression. Inflation has only gotten worse in 2023 and 24, with the rich being owners of assets becoming richer while the poor being owners of debt and requiring credit to survive have become decidedly poorer. When we look at global government debt, we are all well aware it continues to dramatically accelerate higher. This initially began when the U.S. came off the gold standard, and global fiscal imbalances were then settled through credit versus gold in 1980 through the Bank of International Settlements. We had approximately $62 trillion in government debt on a global economy as measured by GDP in 2020 of approximately $84.96 trillion of debt. It will be $82 trillion in 2022 with an expected GDP of $104 trillion. This is $20 trillion of new debt to grow the global economy by the same $20 trillion. Are we growing debt or GDP? It makes you wonder whether we're growing the economy or just debt. Well, the answer is they both are now inextricably economically connected. The question is whether this relationship is sustainable and what will change, if anything. We currently have the expectations that we continue to create credit and debt at a sufficient rate and that it will be sustainable. Are these false expectations? Bad things happen in financial markets when financial expectations are suddenly proven to be false. Here are just 10 areas where credit and debt needs are clearly ballooning. The interest on the U.S. debt is quickly approaching $2 trillion a year and is now more than the tax revenues we're taking in. Unfunded U.S. entitlement liabilities are now more than $80 trillion, with the contributions held in U.S. Treasury bonds increasingly being redeemed for payouts. The U.S. Treasury will be forced to issue more debt to pay the principal owed when these treasuries mature, and they're steadily maturing, to do the payouts of the retiring baby boomers at a rate of $10,000 a day. The green economy is costing trillions and growing, with over $9 trillion urgently needed, according to a recent study by the Financial Times. Climate change is costing trillions, and the COP conferences say much more is urgently needed. The global conflict is forcing the remilitarization of the world, the restructuring of global trade, which is including de-risking, onshoring, and friendshoring, is very costly, but has to be done. The Houthis' sustained disruption of the Asia-European shipping route in the Red Sea is repricing global shipping, insurance, and other costs. Rare earth metals and global commodity costs are continuing to reprice. Between now and 2030, demand for power from the global data centers will easily more than double. Within that comes $50 billion of capital investment in U.S. power generation alone. Uses of de-dollarization are changing the whole mechanics of debt. All must be financed, and all are inflationary. Is our financial system ready for this? The financial system is already experiencing serious secular and unprecedented issues. The Fed has taken rates from 0 to 5% after claiming inflation was transitory. We see mismatched goals as government spends a $6 trillion while the Fed executes quantitative tightening and fights inflation not seen since the 1970s. Withdrawals surge from captive nothing to 5% money market funds. The Fed is forced to implement the BTFP for 1 year, over a year ago, and the regional banks are facing regulatory solvency problems. The FDIC published reports show more than $500 billion in unrealized losses in the U.S. banking sector. There was $620 billion in unrealized Treasury losses last year, with Silicon Valley Bank, Signature, First Republic, and now the Republic First Bank. Federal Reserve, which in theory would bail out the banking sector, and has so far, is itself insolvent by $900 billion. Total Federal Reserve capital is just $51 billion versus $948 billion in losses. This means the Fed is insolvent 19 times over, in theory. The U.S. government, which would bail out the Fed, is insolvent by more than $50 trillion. Daily, we see signs of economic slowdowns and stagnation. With rising inflation and slowing growth, stagflation, which we warned about in our 2023 thesis paper, is near. If something dramatic doesn't change, we are on a path towards a debt crisis by the end of what is likely soon to be labeled the beta drought decade. The question is, are there spending limits controlled by credit and debt growth that will restrict government, corporate, and consumer spending going forward? The short answer is yes, there are. The global pie of growth in credit and debt must be shared. The unwritten rule and reality is that money, credit, and debt always go where it is treated best. The U.S. is an abuser, since it has long consumed more than it produces and finances the difference from that global pool. As this chart illustrates, the rest of the world, in red, is no longer as ready to finance the U.S. as previously. Credit creation is not matching the debt needs, and the Fed has been forced to grow its balance sheet to make up the shortfall. The billionaire bond king and former PIMCO founder of the largest bond fund in the world recently spelled it out, and I quote, "The U.S. fiscal deficit, largely driven by massive rollout of Treasury bonds, is now deemed a necessity to propel the economy forward, which is fueling upward pressure on bond yields. The outstanding balance of Treasuries has surged at over a 10% annual rate for the past 18 months, thanks to post-COVID deficits of $2 to $3 trillion. By the end of 2023, the federal government had racked up nearly $30 trillion in debt. The U.S. economy requires fiscal deficits and net increases in Treasury debt of $1 to $2 trillion or more annually in order for the economy to grow. That is a lot of bonds, according to Gross." And I continue to quote him. While Treasury debt has been growing at a rapid rate, other types of debt, including business and household debt, have been growing more slowly. As a result, in order to make up for this difference, the government must ramp up Treasury debt by over 10% to uphold a 5.5% nominal GDP growth rate. Look for 5% plus 10-year yields over the next 12 months, not 4%, according to Gross. Again, he says, those that argue for lower rates have to counter the exorbitant upward climb in the Treasury supply and the likely Sisyphean decline in bond prices. The end of quote from him. He's pretty clear there. This closely aligns, frankly, with the views held by Matassi. We believe the U.S. is in the midst of a third great bond market, shown here on the right in red. We suspect we are near a bear market counter-rally that will be driven by an already well-telegraphed election year rate pivot by the Fed. A rising employment rate of 4%, as reported by the monthly labor report, is the likely trigger point the Fed is currently watching. It will bring with it a new interest cost control methodology in concert with the U.S. Treasury regarding Treasury debt costs, a relaunch of quantitative easing, and probably a U.S. version of yield curve control. I think all are highly likely, and soon. The mechanics to watch this unfold is through the lens of how credit will lead and where it will be created. Although U.S. economic growth has remained strong so far, the Fed must be concerned that if interest rates remain high, credit growth will slow further and tip the U.S. into a recession. This concern may force the Fed to begin cutting the Federal Reserve rate soon, even if inflation remains above the Fed's 2% target, and we believe it will. We think 3% is probably the lowest it's going to reach. We show here the annual increase in total U.S. debt each year going back to 1952. After a record-breaking $8 trillion surge in total debt in 2020, the annual increase slowed to $6.3 trillion in 2021, $5.1 trillion in 2022, and $4.1 trillion in 2023. Government debt has increased by $23 trillion since 2007, nearly 400%. That prevented two Great Depressions in 16 years. Since 2007, total debt in the United States has increased by $46 trillion, or by 87%. The increase in government debt has accounted for 51% of the increase in total debt. Without that increase in government debt, it is likely that the U.S. economy would have spiraled into a depression, and that the size of the economy would be at least 10% to 20% smaller than it is today. Household debt jumped by a record-breaking $1.6 trillion in 2021, and it slowed to a still large $1.1 trillion increase in 2022, but in 23 it fell back to just $525 billion. Household debt increased by an average of 8% a year between 1952 and 1923. During 23, it increased by only 2.7%. It was the weakest since 2015. The two largest components of household debt are mortgage debt and consumer credit. In both these categories, credit growth was exceptionally weak last year. Mortgage debt increased by an average of 8.1% a year between 1952 and 2023, but in 23 it grew by only 2.8%. The increase in consumer credit was also very weak during 2023, just $126 billion, down from around $350 billion a year during the two prior years. Consumer credit increased by 7.7% a year on average between 1952 and 2023. Last year, it increased by only 2.6%. The $200 billion increase in corporate debt last year was the weakest since the aftermath of the crisis of 2008, down from an increase of $1 trillion in 2020, $730 billion in 2021, and $800 billion in 2022. It grew by only 1.5%. The average annual growth rate since 1952 has been 7.5%. It was a similar story for the GSEs. The debt increased by just $280 billion last year, down from the average annual growth rate for GSE debt between 1952 and 2023 of 13.3%. Last year it was only 2.4%. That was the weakest since 2014. The increase in non-corporate business debt was also weak, just $167 billion. That amounted to a 2.3% increase last year. The average since 1952 has been 8.4% a year. The same weak trend held for the financial sector, excluding GSE. Debt there rose by only $120 billion last year. In percentage terms, the debt of this sector grew by only 1.3% last year. The average annual increase since 1952 has been 9%. The increase in government debt jumped from $1.5 trillion in 2022 to $2.6 trillion in 2023. That was the second largest increase ever. The largest was $4.6 trillion in 2020, the height of COVID. In percentage terms, however, the increase in government debt last year appears less shocking. The 9.8% increase in 2023 had been surpassed many times before. The average increase since 1952 has been 7.2% a year. Government debt accounted for 64% of the increase in total debt. The largest increase in government debt was one of the main reasons the U.S., as I said earlier, didn't fall into a recession in 2023. If the government had borrowed and spent less, it's likely that the other sectors would have borrowed even less than they did. Total credit growth would have been much weaker, and that, most probably, would have thrown the economy into a recession much earlier. Between 1952 and 2009, total credit adjusted for inflation grew by less than 2%, only 9 times. Every time that happened, the U.S. went into a recession. Even though total debt grew at a slower pace in 2023, total debt adjusted for inflation increased by 0.2% last year, whereas it had contracted by 2.3% in 2022. Despite this improvement, total debt adjusted for inflation was still below the 2% threshold in both 2022 and 2023. The reason the U.S. economy has continued to grow despite weak credit growth is due to the extraordinary surge in wealth since the end of 2019. Wealth has boosted consumption and helped keep the economy growing. What happens if wealth creation slows? What happens if it shrinks significantly? What we learned in previous major market crashes was that wealth and leverage collapsed when underlying collateral value shrank. In the last crisis of 2008, it was the value of residential real estate assets falling in price and taking the whole mortgage finance market with it. Could that happen again? The answer is yes, and maybe even more so. My experience has been during every major market crisis I've lived through is that we suddenly, as the crisis unfolds, learn about new terminology and financial methods we had never heard of before or were even remotely aware of. During the dot-com bubble burst of 2000, we learned about asset-backed securities, initial public offerings, which we knew about before but never taken to that level, and rises that we saw, special purpose entities at Enron and the whole use by Enron of the derivative structures and where it went, and currency and interest swaps. In 2008, we learned about credit default swaps, collateralized debt obligations, mortgage-backed securities. Again, we knew about those, but not how broad-based they were, rehypothecation, innovation, and the whole magnitude of leveraged loans being used. I have become much more attuned to looking at this, obviously. Few are aware, in my mind, of what's going on with inflation swaps, CLOs, that is collateralized loan obligations, versus what we saw in 2008 of CDOs, LDIs, liquidity-driven investment, which we saw in the UK, gilt crisis, which nearly brought down the Conservative government and nearly the pension system in the UK, collateral transformations and collateral swaps, which are incredibly broad-based, and that list goes on and on. The result has been the explosion in the use of derivatives, which has a similar profile to the growth in global debt, as you'll see here. The 2000 crisis is marked here by the first vertical red arrow. The 2008 crisis is marked by the second vertical red arrow. We've traveled a long way since the last financial market crisis and the overall growth in global government debt. It makes no sense that a global economy of over 100 trillion would support currency and interest swaps of over 700 trillion in a quadrillion derivative market. A derivative complex that is primarily over-the-counter, unregulated, and with very little, if any, visibility. This is a massive complex which controls almost every facet of the visible and regulated financial exchanges. The next crisis will stem from something breaking in this untested and evolving Goliath as it pushes the continuously stretched credit creation bounds and the assumption of debt. So, what can we conclude? There is no economic growth without debt growth. There is no growth without credit growth. The crisis will occur when debt growth no longer produces growth or insufficient growth. Globally, as we saw earlier, this has already eroded to taking $1 of debt for $1 of growth. In the U.S., it now takes as much as $2.50 of new debt to produce $1 of growth. In the U.S., it takes as much as $1.50 of deficit growth to produce $1 of growth. The velocity of money must be sustainably larger than money supply, or the GDP shrinks. The crisis will be the implosion of the derivative security complex in our mind, an unprecedented supercycle degree collapse. Collateral underpins all derivatives. Collateral will be swept up on a vast scale. All of this couldn't have been clearer when Chairman Powell stressed emphatically that he did not see rates going higher. He convinced the markets that the movements on rates were to be to the downside. Additionally, he announced the tapering of quantitative tightening. There was no reason for him to take this position, with core inflation still very much an issue, especially in services, remembering we are a service economy. The money supply, M2, has bounced to March 2023 levels and has been rising almost every month since October of last year. U.S. government deficit spending has more than offset the decline in the Federal Reserve balance sheet, and the Fed's balance sheet has shrunk by $1.5 trillion from its peak, while the U.S. government deficit remains above $1.5 trillion per year. The Fed is not as concerned about a market correction as it is about maintaining some calm in the bond market amidst an unsustainable increase in government deficit and public debt. The Fed is choosing to keep the sovereign debt bubble alive as a priority over reducing inflation. It is impossible to reduce inflation to the 2% target when the government deficit, which is printing new currency, remains out of control. It is even more difficult when the Federal Reserve delays normalization of the balance sheet, bringing the monthly redemption to less than half the previous figure. The Federal Reserve is reluctant to admit two things. One, the Treasury debt supply is significantly higher than private sector demand, and two, the Fed is more concerned about a potential bond market meltdown than elevated inflation. The Fed's decision could be seen as a dangerous way to keep the government's misguided fiscal policy alive at the expense of making families and small businesses poorer with elevated inflation and higher for longer rates. Powell tries to be prudent and rigorous about inflation. When the government fuels the fire, Powell is like a fireman trying to stop a fire with a bucket of water, while the owner of the building, the government, throws gallons of gasoline all over the ceiling. Or should I say, the massive global derivative structure. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2024 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.